Hi, this is part 2 of the SOFTRAX audio blog for the week of December 17, 2018. My name is Graham Hulme. I'm the Vice President of Product Management at SOFTRAX. We're going to focus today on a 10Q and earnings call highlights for Cisco Systems, Inc. And so, getting right into it, let's talk about the 10Q that Cisco filed for the quarterly period ending October 27, 2018. So in this filing, it's densely packed with over 38 references to ASC 606. And what's notable, and it's presented in a format that's highly intuitive for readers to convey the impacts of 606 on the company, is a table the company presents on page 9 detailing the timing of revenue recognition before 606 and after 606 for its major product and service offerings. And so, if you can, visualize it on a left to right, top down basis, on the left side, the company provides, effectively its major products and services, summarized into categories. Across the top, there's two columns. One is prior to 606 and one is, effectively under 606. And what the company does is it basically makes clear statements whether it was ratable or point in time recognition before 606 and then after 606. And so it's very clear and intuitive to a reader, all right, how did the timing of revenue recognition change for the different products and services the company offers? Because you can look at it side by side before and after. So it's worth a read even to just look at that format in terms of how to present a visual of the impacts of 606 to supplement the qualitative descriptions or narrations in a filing. Beyond that, I'd say, at the bottom of page 9 in the significant judgment section, the company discusses how it arrives at standalone selling prices, and it offers a two-tier approach to do so. And so, in that area, I think I'll quote, "Revenue is allocated among these performance obligations in a manner that reflects the considerations that we expect to be entitled to for the promised goods or services based on standalone selling prices, SSP. SSP is estimated for each distinct performance obligation, and judgment may be required for their determination. The best evidence of SSP is the observable price of a product or service when we sell the goods separately in similar circumstances and to similar customers. In instances where SSP is not directly observable, we determine SSP using information that may include market conditions and other observable inputs," end quote. And so I cherry-picked that because it covered a few key things. One is where they can, where they feel they have effectively, best evidence of SSP based on observable price of a product or services when it's sold separately in similar circumstances to similar customers. That's effectively the top of their food chain to establish SSP. Then what they're saying is that when that's unavailable, that they go to, use information, based on other inputs. Now, those other inputs could be, looking at, if the product or service they're offering is, for lack of a better term, a commodity or something that, other vendors readily provide and has similar function and goes to similar customers, etc. They could use that pricing as, information to come up with their SSP. And so, this is just a good example where a company points out its SSP considerations. It's also notable in that there's no reference to the residual approach here. So it appears, at least reading this section, that they're establishing SSP for their performance obligations without the use of the residual approach, although it's something we'll keep an eye on going forward. In terms of additional information in this filings, what I would say is this, is that while there's 38 references to it, the next area I would recommend you take a look at and that had value in it was the disaggregation of revenue section on page 13. And the reason that it had value is the narration of considerations used by the company to disaggregate revenue at the top of this section, while it's brief, is helpful to set context for the table that follows. And so it's a good example of how the company critically analyzed its business model on an end-to-end basis to identify financial and operational factors that would be used to disaggregate revenue. And so what you can see is that, if we take a look at what the company states, it's really a 2-sentence statement that helps, clarify what they did to disaggregate revenue. So I quote, "We disaggregate our revenue into groups of similar products and services that depict the nature, amount, and timing of revenue and cash flows for our various offerings. The sales cycle, contractual obligations, customer requirements, and go-to-market strategies differ for each of our product categories, resulting in different economic risk profiles for each category. The following table presents the disaggregation of revenue," and then it provides a pretty straightforward table showing how the revenue is disaggregated. I think what's key there is that they're using information such as sales cycle, contractual obligations, customer requirements, and go-to-market strategies, and then looking at product categories, as well as economic risk profiles for each category to come up with how it should disaggregate revenue. So to me, this is instructive both for companies that are about to adopt as their private companies, or for companies that have already adopted but that are looking to mature their 606 implementations. This really could be helpful in terms of just, even though it's a quick read, it might give food for thought on potentially other ways to look at the how revenue can be disaggregated. So it's worth a read, and I thought it would be worth noting here in our audio blog. The second part of this audio blog is the following: is that the company had an earnings call related to this 10Q, and during it there was a very good back and forth between the company and an analyst on 606. So let's get right into it. So the analyst asked the following question: first, on ASC 606, is this just a 1-quarter benefit to revenue, or do you expect any more in Q2 or going forward? And that was an analyst from Macquarie Capital. And so Kelly Kramer, Cisco's Executive Vice President and CFO, answered as follows: sure. So on the first question on ASC 606, so we will benefit from that going forward. The point was this was a little abnormal this quarter because we had 2 very large enterprise multi-year renewals that were very heavy software content that we recognize now. And the new accounting rules you recognize up front. So just to remind everybody of where we are impacted mostly from 606, when we have enterprise agreements, whether these are term-based or not, we'll be recognizing them up front if basically the functionality of the software goes to the customers. So a lot of the enterprise agreements we will all be recognized up front. Cisco One, for example, a lot of that is going to be recognized up front. And even a portion of our enterprise networking, like the Cat 9 subscription, a portion of that now will be upfront, even though some is still deferred. So it's accelerating, basically, big enterprise license agreements. So this quarter we had 2 very large ones, but we will be benefiting going forward. He also continues, and I'll use the Cat 9K as an example. We've talked in the past where we used to sell the previous switch, say it sold for $100, and we recognize that $100 all up front. We're selling the Cat before ASC 606, we sold Cat for $100, but 25% of it was deferred, and we recognized that 25% over, say, a 3-year term, and then they would renew it for another 3-year term. With 606, that 25% that was deferred in the past, about 12% is now deferred, and the other 11% is recognized up front, but that full 25% is what we renew. And so that's why when you look at the software, that's still a subscription software, end quote. So this interaction, to me, that there's key takeaways. One is, the analyst question really is going to the heart of, okay, trying to understand, did ASC 606's impacts, were they at a point in time, or will these be, recurring impacts over time? And then in the company's response, they address that, but they definitely do so in a way where it provides an intuitive example that even if you're not a RevRec expert or an accountant, etc., you could read that and get a sense for, okay, all right, this is how it impacts it. And the example is straightforward and intuitive enough where, it gives you a pretty good understanding of 606's impact, at least on that company. And so it's worth a read in that, whether you're public or private, this question could come up from auditors, internal or external, but also, obviously, if you're public, it could come up on these earnings calls. For privates, it's a good example of how to really think through and prepare examples to explain not only externally but internally to board, to executive management, the impacts of 606. So that's it for part 2 of this week's audio blog. We appreciate your time listening, and we'll talk to you soon. Goodbye.